Hello traders, welcome back to another video. Last week's video we focused on trading strategies, and part of those trading strategies was support and resistance. So this video is building back on that one. If you missed that on the last video, there's some really valuable stuff in there, so make sure you go back and check that out. This video will show you 5 ways to early mastery of support and resistance, how to identify the perfect levels on any price chart that you can actually incorporate into your trading today. I've condensed the best techniques for identifying support and resistance, so be sure to pay attention to this one. I'm certain you'll learn something new. Let's begin. Tip number 1 is to jump up to a higher time frame to view the bigger picture. One of the most important things when drawing accurate levels is to get some perspective on the bigger picture of a market's movement. We can account for the bigger picture by moving up a time frame to filter out the weaker levels of support and resistance in favor of the strongest, most reliable levels that we want to trade from. Let's say you usually trade from a 4-hour chart. Then to view the bigger picture, you want to jump up a time frame to the 1-day chart to get a greater perspective of the cleaner reversal areas to draw our levels at. Take a look at the split screen. The top chart here, this is our higher time frame, and what you can see is a daily chart of the Euro-Swiss franc pair. Now the chart below it, this is our trading time frame. This is the time frame we actually place trades off of, and this is a 4-hour chart. The key technique that I want you to take is that we're going to draw our levels of the higher time frame, and then we'll look at the impact that it has on the lower time frame. So at this point here, we can see there's 2 key reversals that I want to actually capture. So if we draw a line in, we'll notice that the line is reflected on the lower chart as well, which is our 4-hour. What you can notice is that in this chart, there's actually less bounces, but the bounces we can see are the strongest reversal levels, and the more likely to cause a reversal again if we are to retest this level. So these are the levels we want to use. Let me show you one more example so you get the hang of it. Okay, let's jump over to another split screen. This split screen is the Swiss franc to the Japanese yen, and we've got a similar deal here. The only difference is that I've actually changed the time frames. You can use this technique with any time frame. You just need to make sure you have a higher time frame, which is about 4 times greater than your trading time frame. So for example, if you were to trade on a 1-minute chart, then you use a 5-minute chart as your higher time frame. If you were to trade on a 1-hour chart, then you would use a 4-hour chart as your higher time frame. In this example, our top chart right up here is our higher time frame. This is a 1-hour chart, and our trading time frame down here is a 15-minute chart. Let's identify some clean reversal levels. So again, we're going to do the same thing here. We're just going to connect these bounces and draw this level in. Okay, there we go. That's a strong level of resistance. Now if we just draw in some more levels. Okay, and there we go. As you can see, the higher time frame gives us a really nice perspective, especially when it comes to drawing in the strongest levels of support and resistance. This split screen mode that you can see on my screen is available at tradingview.com, but you can always just use a single view like this and then jump between your time frames to get the same effect. Tip number 2 is to look left for additional touches of your level. Tip number 2 builds on the first tip that we went through. When we identify a potential level we can use, such as this level right here, there's a really quick shortcut you can use to determine how strong that level is. Remember this key phrase, look left. Looking left will open up the history of the chart. More importantly, the history of a particular level of support or resistance. You can look in the past by scrolling left to determine if the market previously respected this price level. If we scroll left and find more bounces from the level, then it's proof that we're dealing with a significant level, and it's even more likely that price will respect this level again in the future. As the principle goes, the more touches at the level of support or resistance, the stronger it is. Let's revisit that Euro-Swiss franc chart from the previous tip and look at this principle in action. Okay, what we want to do for this tip is come out of split screen mode, and we're just going to go into the single chart mode to give you a greater perspective. We're currently on a higher time frame. This is the Euro-Swiss, and we're on the daily chart. Just to explain a bit about this tip, we basically just want to look left and confirm any additional touches that have actually occurred on this level. So we first drew this level because we had these 2 touches here of resistance, but to confirm how significant this level is, we want to scroll left, look in history, and look for any additional touches. So as we can see, before it was acting as resistance, it was a support level, and we have a very major touch right here. If we scroll back even further, we can see we have another touch of support right here, and if we scroll back again even further, what we'll notice is that before it was acting as a support level, it was actually acting as a resistance level right here. So we've got a touch of resistance here and a touch of resistance here. So in addition to our 2 initial touches, we have 4 additional touches, which just complements how significant a support level this is. The fact that it's been respected multiple times in the past just goes to show that it's likely to be respected again in the future, and that makes these levels really, really strong. Tip number 3 is the line chart filter. Keeping up with the theme of perspectives, this tip is another great way to only identify the strongest reversal levels. If you're struggling to identify the best level of support and resistance, or if you have identified a level and you want to validate its strength, then switch to a line chart for a simpler way to determine key reversal points. The best way to demonstrate this is with an example. What you're looking at is the US dollar, Canadian dollar daily chart, and for this example, I want you to imagine you're struggling picking the strongest usable levels of support and resistance. When you're having this type of difficulty, to clear things up, just switch to your line chart. The line chart is much cleaner because it only shows the closing price, but the closing price is significant enough to tell us where the key reversal points are, as you can see. And you basically want to draw your line through as many major turning points as possible, just like I'm doing here. When we switch back to our candlestick chart, we have 3 key levels that we can use. Because we combined the line chart technique with tip number 2 of looking left, we now have strong levels which have proven themselves in the past by holding up nicely. The other way to use your line chart is to confirm the significance of levels that you've drawn on the candlestick chart. For example, when you draw your levels on a candlestick chart, you can always switch back to the line chart to determine if a level you identify goes through the major reversal points in the market. If it doesn't, then you should consider redrawing it on the line chart and then mapping it back to the candlestick chart. Tip 4 is to draw levels from the candle body. Follow the 3 previous steps to identify key reversal areas on a price chart, but this step is about how best to position your line. When you draw in a level, you're drawing a line of best fit through the major bounces on the chart, so that if price comes back to this line in the future, you can best prepare for a reversal trade. This chart is the Great British Pound to the US dollar, and we're looking at a 4-hour chart. As you can see, I've identified 6 key bounces around support level, but I'm yet to draw in a line to connect them. What you'll notice is that not all of these bounces happen at an exact level of price, but they happen in a similar area, not too far away from each other. This is very common in the support or resistance level, as you probably know. This is because support and resistance is zone based. We have areas and zones of support and resistance, and our job is to use a horizontal line to best illustrate a support or resistance area, so we can trade it in the future. I often see people who want to draw the connecting line through the wicks of the candle. For example, if you take a look at our bounces, they might draw it through this wick, or even this wick, but really, you need to draw your lines through the bodies of the candle. When I say body, I mean drawing it through the body like this. As you can see, just like I've done, you need to look for a candle body that you can draw the line from that connects as many of the major bounces as possible. When we're drawing in the support level, we're focused on these red candles, and the body that we're looking for is this particular part of the close, which happens right here and meets our line. We need it to meet our line, and you see it comes back down, meets our line again. And then when we're drawing in a resistance level, we're interested in the bullish candles, and we're looking for this part of the close right up here. We need this to meet our line. And that is how we draw in support and resistance at the bodies of the candle. There are 2 reasons to draw your lines through the body of a candle and not the wick. Reason 1, think of the entire candle like a race. The open of the candle is like the starting pistol at the beginning of a race, and the close of the candle is when the runners cross the finish line. The candle's body shows us the open and the close of the market, where the race started and where it finished, which is much more important than what happened during the race, which is what the wick shows us. The strongest levels of support and resistance reverse from the body of the candle and not just the wick. The second reason is that it will keep where you place your levels more consistent, because if you're focusing on the candle body, then you'll place consistent levels of support and resistance every time it comes to placing a level, which will make it a lot easier to test your trading strategy when it comes to it, and it will also make it faster to master your own support and resistance placement technique, if that makes sense, because you're doing the same thing over and over and over again. The more repetition you do, the stronger you'll become at it, the more it will become a real skill set, and that's exactly what I want to happen for you. In tip number 5, I'm going to teach you the swing high and swing low method for placing support and resistance. Our final tip is another one on placement, but a nice one to round the whole subject off, and that's why I put it here. This is a method to make identifying levels much simpler, especially when you're a beginner trader. It's best if I actually show you this one, so let's pull up another chart. The chart that you're looking at is the Australian dollar to the Japanese yen, and we're looking at the 1 hour time frame. For this method, you need a basic understanding of swing highs and swing lows in a market. Now, the simplest way I can explain this is by showing you that the one thing every market has in common is that they move in swings. For example, let's draw in all the various swings of the market just so you get a clearer picture of what I'm actually talking about. Just understand that all of these movements are swings. So for example, if we're starting here, this is a swing, and then we come back down here, that's a swing as well. Then we push back up, that's a swing. We come back down, that's a swing. What you're seeing is that at all of these high and low levels, we're drawing in swings because the market moves in swings. That's what we mean by moving in swings. Let's just draw in an upswing. So an upswing is where we go from this low point right up to this top point before we have to go to the next swing. So at the top of an upswing, before it moves down again, we have a high like this one. This is our high right here. And these highs are called swing highs. So swing highs happen at the top of every single upswing. So then what happens after this? Have another downswing, then another upswing, and this here is our swing high again. The swing high is the highest point, so you measure that by the wick usually. Now if we just draw in a downswing at random, this point at the bottom of the downswing, before it swings back up again, this is a low, and so we call this our swing low. And again, you have them occurring at the bottom of every downswing. So if we swing back up and back down again, this is another swing low, and that's the way that markets move. Now we don't need to go into the detail of drawing in every single swing, but a great placement technique is to identify a group of swing highs or swing lows forming a reversal area, and then position the line between them. Let's draw in a resistance level using this technique, just so you understand how it works. The easy thing about using support and resistance is that you can actually see where the market's reversing. It's quite clear. So we can see the market's reversing here, 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 and here. And all of these sort of reversal points are all in a very similar level. We just might not know how to connect them using a support and resistance line. What we can do here is draw a reversal area, which covers all of our bounces that we can see that we need to connect. Now our job is to place a level of resistance to best capture this whole reversal area right here. Now we're going to use that swing high and swing low technique. So first I draw a short line at each individual swing high that fits inside the reversal area. Make sure you even get some of the swing lows that fall into the area because they are equally valid. Now our task is a lot simpler. We basically need to connect these lines best as we can by drawing a horizontal line between as many as we can. When you're placing your horizontal line, you want to draw it through the body of the candle to keep things consistent. So if I draw a line through here, what we can see is I'm drawing it right at the body of this candle, and what we're doing is we're capturing the most touches as possible. Once we've connected it, all we need to do is remove our markings, and we're left with a solid level of resistance. As you can see, this is a great way to simplify your placement and ensure that it stays consistent and strong as usual. I really want you to take these tips into the trading field with you and maximize your opportunities at trading reversals. I really hope you enjoyed this video. If you did, please be sure to like and subscribe and check out my other videos which are on trend, candlesticks, placing trades and stuff like that. Make sure you head over to www.trade.coach because we're just about to launch a starter kit for traders who are eager to turn their trading around. So go over there, make sure you subscribe to our mailing list for early access to that kit. Thanks for watching and I'll see you next time.